Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today's podcast is going to be another Mailbag episode. So similar to our last Mailbag episode, we're going to go through and answer some of the questions we've received over the past several months. And Andrew, before we get started here, I feel like I should check and see whether there are any pressing questions that you have on your mind these days, whether finance-related or not.
Yeah, I do have one. Is this going to be the year where Michigan finally beats Ohio State?
No comment.
I was afraid you were going to say that.
Hey, well, on the bright side, as we record this podcast, Michigan is undefeated for the 2021 football season.
Let's hope that continues once they actually play their first game.
Yeah, fingers crossed. Well, thank you for that question. And while we won't be diving into it in any more detail, we do want to give everyone a quick overview of what we'll be covering today. And there are 3 different questions we'll be answering. Number 1 is, I don't feel comfortable with investing and don't check my investment accounts, but I'm worried I might be missing something or not taking advantage of everything. Number 2 is, I like to spend a little more money and my spouse is a saver / thinks we aren't saving enough, and we're trying to find a good compromise. So any tips there? And lastly, number 3 is, I'm wondering if I should pay ahead on my mortgage or invest that extra money instead. What's the better use? So Andrew, why don't you start us out with question number 1?
Sure. So with the first question, it essentially comes down to the emotional and unavoidable aspects of investing, which is the constant feeling of trouble ahead or missing out. Or said differently, fear and greed at the opposite ends of the spectrum. It's a legitimate question, and it's human nature to have emotions tied to investing. And it's also one that probably isn't helped by the financial media and the way they like to make people feel like there's always something they need to be doing at any given time. The narrative is that you're missing out if you aren't doing something with your investments in response to what's happening with the headlines or in anticipation of something happening down the road. And there are really 2 sides of the coin to consider with someone who doesn't like investing or checking their accounts on a regular basis. On one hand, this can be a very positive thing when it comes to your long-term investment returns and how well you do over time. As humans, we can often be emotional and irrational, and this tends to carry over to investing, where we get caught up in our emotions and get in our own way. The way the cycle often works is that the stock market goes up and we get excited and want to buy more. Then the stock market goes down, fear kicks in, and we want to sell. And the same cycle or pattern of greed and fear repeats itself. As a result of this, the average investor tends to underperform his or her own investments by buying and selling at the wrong time. In other words, if the average investor fell asleep and woke up 10 years later, they would be better off simply because they weren't able to make mistakes. You think that would be a reality check for some people, yet there are no shortage of confident investors out there, which likely make up the majority of below average investors. So managing emotions and getting out of your own way is one of the best ways to avoid mistakes, which isn't easy, especially if you're checking in each day and reading the headlines. But there have been studies that show an inverse correlation between how often people check their investments and how well they do as investors. In other words, the people who check their investments less frequently have a better investing outcome. Looking at it from that perspective, not checking your investments regularly can actually be a good thing, because it provides some healthy distance in terms of not getting as emotionally involved. And by avoiding seeing the day-to-day, week-to-week, and month-to-month fluctuations, you avoid feeling the stress of the inevitable temporary declines in the stock market and feeling like you have to do something in response to them. Now, at the same time, you don't necessarily just want to have your head in the sand and hope for the best. There are certain things that you will want to do along the way when managing your investments to help you earn a better investment return over time. And we have 2 dedicated episodes on investing, episode number 5 and episode number 19, where we discuss these incremental things you should implement over time in a lot more detail. So be sure to check those out if you're interested, but I'll touch on a few of the key items you'll want to consider. One of them is making sure you have the right mix of stocks and bonds in your investment portfolio, and that you adjust that mix over time as your life situation, the timeline for your investments, and your goals change. Stocks have historically had higher returns, but are also more risky because their prices move around a lot more year to year. Whereas bonds have had lower returns, but have also been more stable and don't fluctuate nearly as much on a day-to-day or year-to-year basis. So you want to make sure your mix of stocks and bonds matches your time horizon for investing and takes into account your unique situation. After you have the right mix of stocks and bonds, you'll also want to make sure your investment portfolio is well diversified. So owning thousands of stocks and bonds all around the globe, rather than just a handful of stocks and bonds in a given country. By having this diversification, you'll also be able to smooth out the ride over time where some of your investments are up while others are down, which can make managing the emotions even easier. Another area you should address is periodically rebalancing your investment portfolio by selling some of the investments that have relatively outperformed and buying more of the investments that have relatively underperformed. The reason you want to periodically do this is to bring your mix of stocks and bonds back to your target allocation, which ideally was set with intention based on your unique goals, investment temperament, and time horizon. So those are a couple of the different things that are helpful to do and are within your control. And by focusing on the areas you can control, you'll be in a better position to avoid or ignore the things you cannot control, like what the stock and bond market will do over any short period of time. However, we know not everyone, especially someone who isn't comfortable with investing, wants to necessarily worry about all these things. So it's helpful to be aware of your options. Well, the obvious one is that you could hire someone to help you, so finding a good financial advisor to work with. But that goes without saying, and not everyone needs to or wants to hire a financial advisor, which fortunately there are a couple other options out there for those DIY people. One of those options is investing in a target date fund, which almost every 401k or retirement plan offers, but you can also buy them outside of just your retirement accounts. A target date fund is a diversified investment fund whose mix of stocks and bonds adjusts automatically over time, depending on the time horizon for when you'd have that target date retirement. For example, there might be a target date 2040 retirement fund for someone who's planning to retire 20 years from now. That fund will currently have a certain percentage invested in stocks and a certain percentage invested in bonds. But the percentage in stocks will decrease and the percentage in bonds will increase. In other words, the fund will become less risky over time as we get closer to 2040 and the person needing to withdraw money from their investments to fund their lifestyle and retirement. So these target date funds are sort of a way to handle the stock and bond mix, diversification, and rebalancing on autopilot for someone who doesn't want to manage their investments. Now, these certainly aren't ideal since they don't take into account your unique situation and goals or the timing of when those changes happen. So you're missing out on a number of opportunities compared to if you were truly optimizing everything with your investments. But for someone who's willing to accept those trade-offs, the benefit of not having to pay attention to or worry about their investments can be a nice option. But for someone who's willing to accept these trade-offs for the benefit of not having to pay attention or worry about their investments, the target date funds can be a nice option. In some sense, it's like picking out the least dirty shirt in the hamper. But the main takeaway here is to get out of your own way and focus on the areas you control and do your best to spend less time worrying about the areas that you cannot control.
So now we'll move on to question number 2, which Andrew and I both got a kick out of this one because we like to joke about how we're different than our wives on the spending-saving spectrum. But the question is, I like to spend a little more money and my spouse is a saver / thinks we aren't saving enough and we're trying to find a good compromise. So any tips there? And this really is a classic question, and it's amazing how often there's a difference between two spouses or partners in terms of one being more of a saver and the other being more of a spender. So this is something we see often. And yes, it's perfectly normal. And the first thing we'll say is that everyone is different and there's not necessarily one right or wrong way to be here. Each person has their own views and attitudes toward money, which we call money scripts. And these are often deeply rooted based on our unique upbringing and life experiences. So they aren't something we necessarily choose. And because of the way they're formed, they aren't always easy to change. So knowing that, and knowing that money can be a contentious issue and a source of stress in relationships, it's really important to be able to compromise and find a middle ground in those situations where two people feel differently about money. And tackling this specific question, step 1 is just making sure you're both on the same page about the bigger picture and what you ultimately want to achieve with your money. We find that even if spouses or partners are different when it comes to spending and saving, they often feel the same way about the bigger picture things they want to accomplish. For example, paying for college for the kids, buying a dream home, or retiring at a certain age. So that's key as a starting point, just making sure you're both rowing in the same direction with the big picture. From there, you can take the next step of figuring out what you actually need to be saving each year to reach those goals on the timeline you envision. We've talked about this process in prior episodes, and unfortunately, it does involve some number crunching, either with financial planning software or various online calculators, so there's no way around that. You have to think about how much money you'll need to reach the specific goal, make some assumptions about investment returns, and use those numbers to back into how much you need to save and invest each year for each goal. And once you do that, you'll have the overall picture of what's required in terms of savings for the different goals, and you can then prioritize them in terms of what's most important to both of you and what's an absolute must-have versus what would be nice to have but isn't important enough to both of you to justify the savings required to reach it. And you might even decide to adjust some of your goals in terms of the timing or the amounts. But either way, once you settle on your list of non-negotiable goals, you'll know how much you need to save each year toward them. After that, the next step is to automate your savings wherever possible, whether that's the automatic payroll contributions to your employer retirement plans, monthly contributions to 529 college savings plans, or automatic monthly transfers from your checking account to your savings account. Once you've done this, you'll know that your savings is on autopilot each month to save the right amounts toward your various goals, and therefore, whatever's left over each month is money that's available to spend guilt-free, knowing that you're on pace to achieve what's important to both of you. And we call this process reverse budgeting, and we have an entire podcast episode dedicated to it. That's episode number 22 if you want to check it out. But by going through this process and knowing that you're saving enough and whatever's left over can be spent, it removes any question or gray area about what to do with money each month, since you know you're on track with your savings. Now, that amount that's left over to spend guilt-free each month may or may not be enough for the person who's more of the spender, but with money, there's only so much to go around, and you're not always going to be able to do everything you want to do. And if it's a big enough issue, you can jointly go back and reassess some of your goals to see if there's anything you'd want to tweak to give the spender a little more to work with. But as long as both people are on the same page and that bigger picture of what they want to accomplish, this tends to be a good middle ground of providing the saver with the peace of mind that they're doing what they need to do, and the spender with the flexibility of being able to spend any available money without constraints. All right, Andrew, you get to tackle the final question for today, which is, I'm wondering if I should pay ahead on my mortgage or invest that extra money instead. What's the better use?
Yeah, well, before I do that, I still think you need to answer my Michigan-Ohio State question because I'm not sure you gave a definitive answer there.
I think we're running out of time here. Sorry.
Worth a shot. All right, with the last question, this is another common one that we hear, and it can be really expanded beyond just mortgages to include all debt, including student loans and other types. It's the classic, is it better to pay back debt faster than what's required or invest the money? When thinking about this question, there are two main factors to consider. One is more obvious, which is looking at it purely from the quote-unquote financially optimal lens, but the other less obvious one is the softer side of what's most important to you and helps you sleep best at night. Looking at this purely from a financial perspective, the question is pretty straightforward. Are you going to earn a better return on your money by paying down debt or investing? When you pay down debt, you're guaranteed to earn a rate of return equal to the interest rate on the debt. The higher the interest rate, the higher the return. For example, if you have a mortgage at 3%, you earn a guaranteed 3% return on any money you use to pay down the mortgage faster than what's required. When you invest, on the other hand, you expect to earn a certain return over the long run, but there's no guarantee and your actual return will vary year to year. Just to provide some context, historically, investing in the stock market has provided a 10% average annual return, while investing in the bond market has provided a 4 to 5% annual return. So based on that, over longer periods of time, you would expect to be better off investing in a diversified stock and bond portfolio rather than using the money to pay back the debt faster, assuming it's a low interest rate debt like a mortgage. However, there are some important caveats to add. The first is that there's no guarantee that the future returns from investing in the stock and bond markets will be similar to the past. And second, no one has a crystal ball. So it's impossible to know ahead of time what will happen with the stock market and if you'll be better off over any particular time period. For example, there will inevitably be periods of time when the stock market is temporarily down, and during those periods, you'd be better off using the money to pay back debt faster, and you might kick yourself if you decided to invest it instead. However, the longer the time horizon, the easier it is to stack the odds in your favor with the financial side of this decision, since there tends to be less variability around stock market returns the longer the time period you're looking at. So the punchline is that from a purely financial perspective, the odds are that you'll likely be better off in the long term and can earn more money by investing extra cash flow rather than using it to pay down low interest rate debt, like mortgages, and especially with interest rates as low as they are right now. And one thing to note here, be sure you're doing what you can to minimize the interest rate on your debt. So it's worth looking into refinancing options for your mortgage to make sure that you're getting the lowest rate possible. And if you have high interest rate debt, like credit card debt, always pay that off before doing anything else. So that's looking at this question from a financial perspective. But the other factor to consider is the softer side of things. That is the more gray area and varies from person to person. People aren't computers, and there are feelings and emotions that come into play with personal finances. When it comes to debt, different people feel differently about it. And some are fine with a large mortgage or student loan balance for a longer period of time, while others are stressed out by having any debt. This is especially true as people make the transition into retirement. If you're someone who falls in the latter camp of being averse to debt, it might make sense to pay back debt faster than what's required, even if it isn't the quote-unquote financially optimal approach. It's tough to put a price on a peace of mind, and getting rid of your debt sooner is going to lower your stress and help you sleep better at night. That's worth a lot in our opinion. It also has the more immediate reward of making progress on your overall financial picture as opposed to waiting 20 years to fully reap the reward of the financially optimal approach. So know that you don't always have to focus on what's financially optimal, and this other side of the question is just as important to consider as well. And tying it back to what I just discussed with the financial side, for people who want to do the best thing with their money, but also like the feeling of making progress faster than expected with paying down their debt, a balanced approach can work well. So with a mortgage, rather than following either extreme of not paying anything extra each month or using all extra cash flow to pay ahead on it, a good middle of the road approach can be paying a little bit extra each month, whether that's $100 or a few $100s. Doing it this way can feel good psychologically because you have that sense that you're making progress with paying your debt down faster, but at the same time feel good that you're generally optimizing the way you're using your money by putting most of the extra cash flow towards a better use. As we've mentioned many times in the past in the podcast, because everyone is different and has their own unique situation, there's rarely one black and white right answer when it comes to managing your finances. And the goal is to figure out what works best for you.
Yeah, that's so true. As much as we all might like it to always be a straightforward, one-size-fits-all approach, that's almost never the case, and each person's situation truly is different. Well, that covers it for today's episode, and thank you to everyone who's shared questions so far, and if any of you have questions you'd like us to answer on the show, you can email them to us at info@mdwmllc.com. We love hearing from our listeners, and we want to make sure everyone has the chance to have their questions answered. so please don't be shy there. And as always, you can find the show notes and any links for the episode, including the links to some of those different podcast episodes we referenced, at mdwmllc.com/podcast. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.